for joining me for my first market update by video. Now, if you like this, please let me know, and I will continue to do some updates by video instead of writing an email or writing a blog. But it's July of 2024, and I want to share some thoughts on three key areas. One being where we at year to date. We'll look at the markets in 5 charts. Secondarily, what's going on with market volatility and the concentration in the markets. And then last but not least, what's our current situation? What's our outlook? What risks are we facing? What should we be thinking about for the rest of the year? And so just to start, markets year to date in 5 charts. Overall, when we look at this, we see that most of the markets around the world are in the green. We do have some that are in the red, but most of them are in the green. And the US has some of the best performing markets year to date. In fact, there are just a few markets that have outperformed the US this year so far. A couple of the notable ones would be Taiwan and India, and they're up very nicely. We also have Peru here in the Americas and Turkey in the Mideast, but other markets around the other country markets around the globe are in the single digits. Now we're only halfway through the year, so a single digit at this point in time is still a good return. And if we double that, they could be in double digits by the end of the year. If the market were to, continue to go up at exactly the same pace that it's gone up in the first half. Italy, Greece, United Kingdom, both around that 8%. But within the US, let's take a step back and look at, well, what is driving the returns in the US? We've had that really good return year to date. Most of it, as you probably know from all of the news, is coming from a few large companies. And so when we look at the factors that are creating the growth in the S&P 500, that's coming from large cap growth and then the momentum style. Now, factors allow us to separate the return into what is causing that return. We call those factors, and we have the qualitative factors. We then have size, the large cap companies, the mid cap companies, the small cap companies. We have the value versus growth style, and then we have the investing styles, the momentum or low volatility or high dividend. And so when we look at these factors, we see that there's really only 2 that are providing most of the return in the market year to date. And that is because most of the return is coming from just a few companies. And we'll look at that in a minute. Commodities year to date are a mixed bag. We've got a lot of negative returns in the agricultural area. We've had a lot of conflicts in areas where we rely on getting some of our agricultural supplies, as well as a lot of natural disasters, fires and hurricanes and the like. But in the areas of energy and metals, both of those are very strong year to date. And I want to point out that in the area of energy, energy is very volatile, but I want you to think about where energy might be going, because not only are we needing to power our houses, more electronic devices than ever before, more electronic cars than ever before, but we're now also needing to create and build more data centers. And 10 years ago, a data center took about 10 megawatts to run. Today, a data center is going to take 1 to 200 megawatts to run. So 10 to 20 times the amount of energy needed for a data center than in the past. And we're just going to need more data centers as we build out more and more of these, AI capabilities. Last but not least, when we look at fixed income factors, we see that across the board, what is up are the short duration or the floating rates, the Treasury inflation protected securities just slightly. All of the longer term fixed income factors are underwater. And this is going to continue until we have an answer to what's the Fed going to do, what's inflation going to turn out to be, when is the Fed going to reduce rates. And there's also some credit issues that are working through the system right now, because we have loans that need to be repriced, that need to be re-upped, and rates are higher than they were. And so there's some credit issues that are working through the system. And until these things are resolved, I think the midterm and long term are going to suffer for a while. When the Fed cuts rates, that could turn and that could change. And so we want to monitor that and be aware of that. But let's now talk about what's going on here in the US in terms of volatility and market concentration. We are currently, year to date, we're currently at a point where we've had a very long period without having a 2% or more decline in the S&P 500 in a single day. 334 days plus since we've had that happen. Now, this is not the longest time that we've gone with that low volatility. We've had some other periods where the low volatility has lasted even longer than current. But when we have low volatility like this, it can create some lack of attention to the risk inherent in different investments. And so it can create some pockets of money going to investments that people wouldn't necessarily put their money at if they saw the volatility that might come back and be a little bit more normal relative to some of these other periods of time. So be mindful of the volatility that is within the system or the lack thereof, and be ready for it to come back. When we look below the surface, we see that there actually is a little bit more volatility than what we're seeing. And that's because the S&P 500 and all of these other indices are reported in the whole. So we're reporting all 500 companies that are in the S&P 500. And year to date, the S&P 500 is up 12%. Well, this was prepared on June 10th. So at that point in time, when Schwab prepared this, the S&P 500 was up 12%. It had seen a 5% maximum drawdown from the high. Now, a 5% drawdown is very normal. That is just a normal correction. That is not anything to be concerned about. We're now, from that drawdown, we're back up 14%, and that's where that gives us our overall 12% year to date. But the average member in the S&P 500 has had a maximum drawdown from the high of 15%. And these numbers are even bigger if we look at the NASDAQ. The NASDAQ's had a maximum drawdown of 7%, but the average members had a maximum drawdown of 39% year to date. Looking at the S&P 500 from the low in October of 2022, it's up 50%. And we had a maximum drawdown in that period of time of 10%. That's a very, again, normal correction that we would need to have from year to year. But the average member within the S&P 500 has had a 27% drawdown, maximum drawdown in that period of time. And when I say average, I mean not the most. This is the average of the members within the S&P 500. So there are some that would have been more, others that are less. Now, looking at the returns, and we talked about the fact that there are a number of companies that are large companies that are generating most of the return in the S&P 500. Well, this chart really points that out. This is also prepared by Schwab as of June 10th. And we see that over the last year, only 7% of the companies in the S&P 500 outperformed the average S&P 500 return. The other 93% underperformed. And over the last 6 months, it's been 19% of the companies in the S&P 500 that outperformed, which means almost 1 in 5, not quite 1 in 5, has outperformed, and the other 4 out of 5 has underperformed. That's something to be aware of and to be monitoring. This picture really brings it to light. And here we're looking at the return year to date. We're looking at what amount of return has come from the fabulous 4, Meta, Amazon, Microsoft, and NVIDIA, and how much the other companies have contributed to the total return of the S&P 500. Well, we see that fabulous 4 has generated a return of 6.5%. And the other companies have generated a little more than 5%, 5.18% in that same period of time. So those Fab 4 has been more than half of the year-to-date return as of the point in time that this snapshot was taken on June 12th. And sometimes people will think, well, are we at risk of having the same kind of situation that happened in the dot-com bubble? We've got these companies that are really, their prices running up, they're outperforming. Are we at risk of what happened during the dot-com? And this chart shows a bit of the story. In the dot-com, which is this lighter blue line from the low in July of 1996 all the way through March of 2000, we ended up with a very large run up there at the end and a total 700% gain. From March 20 of 2000, the low at the COVID crash, to current, even though we've had a very large run up in these large companies, the NASDAQ is at 200% gain. So instead of the NASDAQ being at 700% gain, we're at 200% gain. So we don't have the same very steep run up that we had back in the late 1999, early 2000 time period. And so that should give you some perspective on where we're at relative to being in a big bubble. We do, however, have a lot of concentration within the market. Again, those top 4 are producing a lot of the returns. It's not the first time that we've had our 4 largest stocks in the S&P 500 be such an outsized position, an outsized piece of the pie. Back in 1964, AT&T, General Motors, Exxon, and IBM made up almost 25% of the S&P 500. Today, Microsoft, NVIDIA, Apple, and Alphabet make up almost 25% of the S&P 500. So we've been here before. We've had this much concentration in the past. It could go on for a while. If other companies begin to grow relative to the growth of these 4 companies, then that will turn around. But it's something, again, to be mindful of. What is the risk in that, and make sure that your portfolio is not overly exposed to too much return being based on just 1 or 2 or 3 or 4 companies. Now, when we look around the globe, we are not the most concentrated. We are actually number 9 on the list. This is as of 2023. And there are 8 other countries that have a higher level of concentration in their stock markets than we do. And so you can see that those are Canada, Taiwan, the UK, South Korea, Germany, Australia, France, and Switzerland. So this is not unheard of. The large companies are doing well, they're growing, they're becoming more global, and so they're taking up a bigger percentage of those equity markets. And that leads me then to say, okay, where are we at now relative to the rest of the year here in the US? And there are 5 areas of risk that I think we need to be mindful of at this point in time. One is the economic trends. And are we going to have that soft landing that they keep talking about? Or are we going to actually enter a recession? We don't know yet. So far, it looks like we're still in growth. It looks like the economy is humming along. It looks like we're going to have a soft landing. And if we can continue to have growth, then we can grow our way out of the situation that we're in. But, it could always turn the other way. And we want to monitor that. There could be policy mistakes. The Fed could raise rates too soon. They could raise rates too late. There could be other policy mistakes. And that is always a risk that we can't control. Then there are the geopolitical tensions around the globe. And, those are disconcerting, certainly, and we don't want to see the conflict, but they also can create a lot of shocks to different supply chains, shocks to our energy supply. And so that can be an area of risk for our markets. Natural disasters are another area of risk. We've had a lot of natural disasters lately. I'm here in Texas and just had a major hailstorm that we haven't had like this in a long time. But then there are other people that have had the hurricanes and the fires and all of these things, and they do impact communities. They impact the growth. They pull people out of work, or there's other issues that they can create that can have an impact on our food supplies. And then last but not least, the stock markets are overvalued. And that is something that will reduce our returns going forward. Now, we've had very good growth, which means that the prices of our stocks are higher. And we like that. We like higher prices. But that puts us in a position where our price to earnings ratio, that PE ratio, is also high. And when our PE ratio is high, then we have less room for growth over the next 10 years. There's been study done on this, and looking at high PE ratios, we can see that over the coming next 10 years, that tends to produce a lower return because we're starting from a higher point relative to the price. We have less room to grow. Now, looking at the rest of this year, I think the two biggest things that I'm watching, that probably you're watching, are what's the Fed going to do and what's going to happen with U.S. elections. And I'm watching this just from the basis of, well, what is the short-term volatility impact going to be? Is the Fed going to cut rates? And if so, when are they going to cut rates? The market is expecting that they would cut twice, once in September, once in December. I'm really thinking that maybe they cut once. And we'll just have to wait and see. If they do cut rates, that could set us up for better corporate fundamentals next year. It could also help with equity returns for the second half of this year. But if they don't cut rates, or if they raise rates, that's going to create some short-term volatility because the market is expecting that they will cut rates. U.S. elections is also another event that could have some impact on short-term volatility. And it's not just about the presidential election. It's also about Congress. Which way is Congress going to swing? Is it going to stay the same? Are either the House or the Senate going to change? Currently, the Republicans control the House with 6 seats. There are 3 vacancies. The Democrats control the Senate by 1 vote. And if either of those shift, then we could have a shift in the power. If they stay the same, then we could have the same gridlock for the next 4 years. And so as we get closer to these events, to either the Fed cutting rates or to the elections, and we see more clearly what will happen, we'll know more clearly how that impacts our investment thesis. And some people will want to take action based on that. They'll want to either put more into the markets, take some out of the markets. And as those changes are made, as people adjust what they're invested in based on the short term, then that's going to have some short-term impacts upon market volatility. That won't last a terribly long time. We'll get past that and we'll be back to the market focused on the market and not focused on these things. But these are a couple of things that could create some short-term volatility for us. And talking about the Fed is revising their estimate of the long-run neutral interest rate, and that's being revised upward. And it's important to understand that because interest rates drive valuations. So if we have a higher neutral interest rate going forward, then our valuations for stocks, bonds, all other assets are going to be lower. Because when we discount our expected future value, our expected cash flows from our investments, bring them back to present using a higher interest rate, it results in a lower current value. And so if the market begins to think that we need to price in a higher long-run neutral interest rate, then some of the valuations could be adjusted downward as a result of that. And that would just be math, but it can impact the numbers for the short term. We're currently, however, in a very good place in the S&P 500. This is looking at the last 3 years. And what we see is that we're in an uptrend. And the uptrend looks like it will continue from here. What you see on this chart is the blue and red line is the S&P 500 that's represented by SPY, the Spider S&P 500 Exchange Traded Fund. We see that the purple line is the 50-day moving average, and the red line is the 200-day moving average. The purple line, the 50-day moving average, is above the red line, the 200-day moving average. So that means that our recent prices for the average of the last 50 days are above, higher than the longer term prices, the average of the last 200 days. So we're in an uptrend, and our 50-day moving average is above the 200-day moving average. On top of that, the S&P 500 itself is above the 50-day moving average, and it's been above the 50-day moving average for most of the year. This is just looking year to date, same chart, just zeroing in on year to date. And there was a brief period of time in April where we had that pullback where the S&P 500 dropped below the 50-day moving average, but then it moved back up, and it's currently above the 50-day moving average. These things can change, obviously, reasonably quickly, so something to keep an eye on. But for now, we're still in an uptrend, and that's still, going strong. And so when we look at our U.S. markets, our equities are the strongest relative to the other areas of the market. This graphs out the areas of the market on a relative strength basis and tells us which of these categories is strongest, and then within each category, which is stronger than the other. So our domestic equities are strongest. Large cap growth, as we already talked about, is the strongest of those categories. Small cap growth is the weakest. And then when we break it down into sectors, technology is the strongest. Obviously makes sense with NVIDIA and all of the other companies that are in that sector. Real estate is the weakest. And we have a lot of empty office buildings, and so it's very obvious why real estate is currently the weakest. There's going to be great opportunity for somebody in real estate, but for now, we're staying away from real estate until we see that it begins to turn the other direction. We want to invest in the areas that are the strongest and overweight the areas that are the strongest and underweight the areas that are not doing as well. Outside of the domestic equities, we have commodities next. The metals are doing best. This says that the energy is the weakest. Now, we saw that energy is up year to date, and we talked about the fact that there is reason that energy should be strong over the coming years as this whole AI scenario plays out and the need for all of the energy to fuel not only that, but the other things that we're doing with our lives with technology. But it is currently showing up as the weakest on this chart. Commodities is stronger than international equities. International equities have still continued to struggle, underperforming the U.S. There's an expectation that at some point in time they will outperform the U.S., but they are still underperforming the U.S. But within the international, Europe is doing the best. Asia is the weakest. Below cash, we have our currencies and then our fixed income. Now, in the currency area, the dollar is the strongest, and the dollar has been strong, and it has regained, made up for some of the losses of last year. And there would be often the reason for that would be that around the globe, investors are feeling risk adverse and they're wanting to put their money into a safe haven and put their money into the US dollar. But with all the other markets up year to date, for the most part, it seems that maybe it's just because we have better interest rates and the interest rates are drawing some of those dollars into the US. We'll have to see how this plays out. And then fixed income is at the bottom. Now, when the Fed begins to cut rates, if stock markets begin to fall, the Fed cuts rates, and that improves fixed income position, then these things will shift. And that is something that we'll be watching. But for now, this is the current situation that we're in. Relative to the rest of the year, where might the S&P 500 go? Now, in most years, the S&P 500 is up. It's up 3 out of 4 years. And what's interesting is that if we look at the last 20 years, we see that over, on the average, the second half of the year is better than the first half of the year. We're about to enter the second half of the year. Usually, July is a pretty good month on the average. So out of the last 20 Julys, it has on average had a pretty decent return. We'll see if that happens again this July or not. But then beyond July, we tend to have this kind of flat line period from August through October, and then we get back to some growth at the end of the year. This is one way of looking at what has happened historically. We know that that doesn't mean that it'll happen that way this year. We might bring the average up and we might bring the average down. We won't typically hit the average. We're going to impact it one way or the other. And so we'll want to continue to watch what's going on. But again, right now we're in a position where we're moving upward. And so that could bode well for what's going to happen over July. Now, the actions that we're taking for our clients. If you're a client, we're looking at your portfolio. We're wanting to check that your short-term assets are going to cover your short-term bucket. We're wanting to check your allocation. Make sure that you still have the right mix of the stocks, bonds, alts that are in your portfolio that fit your plan and that fit the level of risk that you want to have. Some of you want more risk, some of you want less risk. And then we're checking your sector exposure. Like I said earlier, we want to be overweighted to those areas that are outperforming, and we want to be underweighted to areas that are not outperforming. We're looking at the holdings to replace those low quality holdings with high quality holdings. And that's something that we want to look at on an ongoing basis. But where we can do that and pull up the quality of holdings in your portfolio, then we're doing that. And with that, we're considering tax loss harvesting and tax gain harvesting. Do we have room for taking advantage of losses, gains, depending on your tax situation? And if we do, then we want to talk about that, make sure that we're all on the same page relative to the tax plan for this year. Big picture, we're monitoring the volatility, when that might come back at a higher level, and the risks that are facing us ahead of us for the rest of the year and going into next year, just to stay on top of any changes that need to be made. Now, if you are a client and you want to talk about your portfolio, just send me an email. We can schedule a Zoom, schedule a phone call, get together, have a meeting, whatever you might want to do so that we can talk about your portfolio and your plan, make sure that everything's on track, make sure that it's up to date with any cash flow needs that you might have. If you're not a client, then I hope that this has been helpful to give you some things to think about, to focus on relative to your retirement portfolio and how that's supporting your needs and how you might need to be aligned in this period of time. If you don't have an advisor, feel free to send an email and reach out. I'd be happy to have a conversation. But like I said, I do hope that this has given you some good information that you can use to improve your retirement, because I want you to be on your best path in retirement.